Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, are you missing out on the potential of global markets? Should you invest in international markets and what are the options to do so? Let's discuss with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First up, let's, if you could tell us why should an investor consider investing outside the domestic market, and are there any benefits to doing that?
If you're a long-term investor, you should invest in equity. And the reason why you should invest in equity is the reason why you should invest abroad. Mm-hmm. One is that, let's just understand the context of the global market and how we stack up. Mm-hmm. The global market, all the stock markets of the world put together, they add up to $124 trillion. Mm-hmm. And we are less than 5%, 4% of it. We are 3.9% of the total market. Okay. So that itself, we are a very tiny blip in the overall scheme of things, of the world affairs, of business affairs, or the listed business universe. It could be more if all our public sectors and others are listed, but that is not an investment option. So we have limited investment option. Mm-hmm. Second is that, we keep saying that diversify to reduce your risk. And diversifying, investing abroad is a very important diversification for you. Mm-hmm. Because our jobs are here, our assets are here, our house is here, and our sources of income is here. And all our investments are also here. Mm-hmm. So at least you are able to spread against that. You are able to hedge against that. Third is that, rupee has depreciated over the last 30, 40 years. Mm-hmm. And to benefit from that, you have to invest abroad. Mm-hmm. Because you take your 100 rupee, turn it into $1, and get it back 5 years later, and rupee has depreciated, so you don't get 100 rupee back. You get 105 rupee, 104 rupee. Mm-hmm. So you are able to benefit just. So if you have a nominal appreciation of the assets, add to that the currency depreciation, it makes it more. Mm-hmm. And then comes the real reason why one should invest abroad. Simply, there are superior alternatives. All the great alternatives won't be in India. Mm-hmm. You have to really buy into this. And if you look at all the big innovations, great businesses, great opportunity, larger businesses, fast-growing businesses, innovative businesses, you come across all of them all over the world. Mm-hmm. You should also own them.
Right. So how should one go about investing abroad? What are the options available?
Broadly, there are two ways of investing abroad. One is that you invest in them through a mutual fund. So most of the headache, or call it the difficulty of investing abroad is taken care of because you invest like a domestic. The way you invest in an Indian mutual fund is the way you invest in the ones which are registered with SEBI and sold by domestic mutual fund companies. Mm. The other is that every Indian citizen can invest up to $250,000, which is equal to 2.14 crore rupees. Mm. 2 crore rupees annually, every citizen can invest abroad. Mm. You can take that money out and invest, open an account with a brokerage and you can invest. Mutual fund is an easier way. And within mutual fund, when you decide to, invest in mutual fund, there are multiple structures available. One is a fund of fund. A domestic fund floats a fund, and which in turn invests in another fund. Mm-hmm. That is a fund of fund. There could be a domestic fund which invests abroad. There are many funds in India which is available where instead of investing in India, they're investing in US, or there's a particular thematic thing, or there's a definition, there's a charter, and they're investing in there as per that prospectus. Mm-hmm. Third is that there are funds which are index funds of abroad. Mm-hmm. You have the FANG Plus, you have the NASDAQ fund. So these are different vehicles. The design does not matter because, SEBI is very, there's a very stringent regulatory framework for them. The where they invest also matters. It is dependent on that regulatory jurisdiction as well. And then, the distribution and everything is very convenient. You can set up your SIP the way you do it. Investing abroad through a broker and investing directly is one aspect. Mm-hmm. Investing through mutual fund is the easiest route. Mm-hmm. The third route could be that you take that $250,000 abroad and buy a mutual fund which is listed abroad. Don't buy
not the domestic mutual fund, but
take your money to a brokerage and invest in a mutual fund abroad.
Okay.
So you are able to de-risk yourself from all the risk of investing in stocks directly in an overseas unknown market. And the problem is why you should consider that, simply because today it is not possible for domestic investors to invest in any fund because of the regulatory ceiling. RBI has put a restriction that which has led to most international fund stopping to take
Fresh investments.
fresh investments.
All right. Now, what are the risks involved in investing abroad, and how can one manage them?
Same risk as domestic funds. Normally we get attracted to something and we end up chasing past performance. So there is a possibility that many a times our choice of an international fund might be based on what has done very well in recent past.
Right.
And we may not have enough reason to understand. Then besides that, if you're getting into a specific geography, assuming that you are investing in a fund which is, of course, we don't have those exotic options, but assuming that you have to invest in a fund which is Vietnam or Brazil or something, so it will have a very unusual context which you may not understand. Like, for example, investing in a fund domiciled or investing in Taiwan, it will be almost a semiconductor fund. Or investing in a fund in Brazil, it will be entirely a natural resources fund because of the geography and the dominance of a certain kind of businesses there. So understand that. Don't blindly chase performance. Chase diversification. Chase promise. Evaluate some, and just ask those important questions before you make those investments.
All right. Now the final question: is there a set of investors that should avoid investing in global markets right now?
No, I think every investor should invest abroad. What percentage and how, you can keep it very simple. There are domestic funds where 10, 15, 20, 25, 30%, up to 35% investing abroad is possible and enabled in many domestic funds as well. Many of those simple investors should consider investing in those funds. It is like investing in a domestic fund. 2/3 of your money is invested. If you're doing a 5,000 rupee SIP, your first stop should be on one of those funds which also invest abroad from that portfolio itself. I think every investor should invest simply because, the diversification and the benefit and the de-risking makes it very compelling.
Okay, now moving on to the viewer's question. Sriram asks, what should be the minimum number of years I should do an SIP for? After that, should I withdraw or let it be? If I leave the mutual fund without further investment, then when should I withdraw?
All the question which Sriram is asking, the answer lies with him. Sriram should, for how long he should invest, depends on how long he can actually keep saving. Save as long as you can. So that's the answer. Keep investing, keep doing your SIP, and make sure that you're doing for 5 years and more. Otherwise, you'll be disappointed. When should you withdraw it? When you need it. So the answer is for him to decide. Because most people investing in India, they're coming from the old thought process that every investment has a term. Right. You make a deposit, or you buy a term deposit, or you do this or you do that, and on a certain day it expires. You take your money, or the money remains idle. Open-end mutual fund is not like that. You invest in a fund, it lies there, it keeps working, it goes through the ups and downs, and in a couple of years it generally turns out to be rewarding. And if you just leave it, it'll still keep working. Just that it does not come with a term. It's an open-end fund. Most other investments, erstwhile investment or the legacy investments we are used to, they always come with a term. It has an expiry date. It comes to an end. In fact, many savings bank account also comes with an expiry in a way that they become dormant if you don't go and reactivate it. That only reinforces this thought process that you have to do something about it after a certain point. No, not really. If you have chosen a good fund, it will keep working for you, even if you forget it.
Well, that's all we have for you in this episode of Investors Hangout. Keep watching the space for more information. Thank you. Bye for now.